Global currency reset has begun. 2026 investors must watch. You're watching the news, and there's another story about BRICS nations meeting to discuss alternatives to the dollar. You scroll past another headline about record government debt levels. You see central banks buying gold at rates not seen in decades. And there's this nagging feeling in the back of your mind that something big is happening. Something fundamental is shifting in the global financial system. But you can't quite put your finger on what it means for you and your money. And then you hear people throwing around terms like currency reset and de-dollarization and monetary realignment. And part of you wonders if this is real or if it's just more internet hysteria. Because honestly, every year for the past decade, someone's been predicting the collapse of the dollar, the end of the current system, some dramatic financial reset that's always just around the corner, but never quite arrives. My name is Jack, and I spend way too much time studying monetary systems, geopolitical financial trends, and specifically trying to separate real structural shifts from the constant noise of apocalyptic predictions that flood the internet. And what I've been noticing in 2026 is that something genuinely different is happening. Not the Hollywood version of a currency reset where everything collapses overnight and we're all trading gold coins for bread. But something more subtle, more gradual, yet potentially more significant. A slow-motion realignment of the global monetary order that's been decades in the making. Because here's what most people don't understand about currency resets. They don't happen like a light switch. They happen gradually, then suddenly. They're the result of years or even decades of imbalances building up until the system can't sustain itself anymore and has to reorganize around new realities. And the signs that we're in one of these transition periods right now, they're everywhere if you know what to look for. So if you've been feeling like the financial ground is shifting beneath your feet, if you're wondering whether you should be doing something different with your investments, if you want to understand what's actually happening beyond the clickbait headlines, this is for you. Because understanding these shifts isn't about predicting the apocalypse. It's about recognizing change early enough to position yourself intelligently for whatever comes next. The dollar's slow-motion transition. Let's start with what's actually happening, because the reality is more nuanced and more interesting than the sensational headlines suggest. The US dollar has been the world's primary reserve currency since the end of World War II. That means most international trade is conducted in dollars, most countries hold dollars as their main reserve asset, and most commodities are priced in dollars. This system, often called the petrodollar system because of oil's role in it, has given the United States enormous advantages for decades. But advantages don't last forever, especially when you're running massive deficits year after year. The US national debt is now over $35 trillion. That's larger than the entire US economy. And it's growing by roughly $1 to $2 trillion every year. At some point, the math stops working. At some point, other countries start wondering if they really want to hold assets denominated in a currency whose issuing government keeps creating more of it to fund spending it can't afford. And that's exactly what we're seeing now in 2026. It's not a sudden collapse. It's a gradual diversification. Countries are slowly reducing their dollar holdings as a percentage of their reserves. They're conducting more trade in their own currencies. They're building alternative payment systems that don't rely on the dollar-dominated infrastructure. China and Saudi Arabia, for instance, have been conducting oil trades in yuan. That's significant because oil has been denominated in dollars for half a century. India and Russia are trading in rupees and rubles, bypassing dollars entirely. The BRICS nations, Brazil, Russia, India, China, South Africa, and now others joining, are actively working on alternatives to dollar-based systems. Now, does this mean the dollar is going to zero next week? No. Does it mean the dollar's dominance is unraveling gradually in a way that will fundamentally reshape global finance over the coming decade? Probably yes. I remember talking to a friend who works in international finance, and he said something that stuck with me. The dollar's decline won't be a crash. It'll be death by 1,000 cuts. Each one individually doesn't seem like a big deal, but cumulatively they change everything. And that's what we're witnessing. Each individual shift, a trade agreement here, a payment system there, seems minor. But collectively, they represent countries building the infrastructure for a world that's less dollar dependent. And once that infrastructure exists, the transition can accelerate quickly. Why this time actually is different? I know. You've heard this time is different before, and it's usually wrong. But here's why the current situation has characteristics that genuinely distinguish it from previous predictions of dollar doom. First, the alternatives are more viable now. In past decades, if you didn't want to use dollars, what were your options? The euro was young and untested. The yen had its own problems. The yuan wasn't freely convertible. There was no realistic alternative, so countries complained but kept using dollars because they had no choice. But now, the euro is established. China's currency is increasingly internationalized. There are multiple potential reserve currencies. More importantly, there's technology, digital payment systems, blockchain infrastructure, CBDCs, central bank digital currencies, that make it easier to conduct international trade without relying on traditional dollar-dominated systems. Second, the geopolitical environment is different. During the Cold War and the decades immediately after, the US was the unquestioned financial and military superpower. Countries used dollars partly because of economic efficiency, but partly because of American power and protection. That's changing. China is a genuine rival. Russia, despite its problems, is showing it can survive outside the Western financial system. Many countries are hedging their bets, building relationships with both the US and its rivals. Third, and this is crucial, the US has weaponized the dollar in ways that made other countries nervous. Sanctions, asset freezes, cutting countries off from SWIFT, the main international payment system. These actions demonstrated that dollar dependence is a vulnerability. And countries don't like being vulnerable. So they're building alternatives not because they necessarily want to challenge the US, but because they want options. And fourth, the debt levels are genuinely unprecedented. It's not just US debt, although that's severe. It's global debt, government debt, corporate debt, personal debt. At some point, this debt has to be dealt with through some combination of economic growth, austerity, default, or inflation. And inflation, which means currency devaluation, is usually the path of least political resistance. I think about this like a game of Jenga. For decades, we've been pulling out blocks, adding debt, printing money, running deficits, and the tower has stayed standing. But there are only so many blocks you can remove before the structure becomes fundamentally unstable. And in 2026, we might be approaching that point where one or two more blocks make the whole thing teeter. What's happening with gold and commodities? Here's something that doesn't get enough attention in mainstream media but is extremely significant. Central banks have been buying gold at record rates over the past few years. Not Western central banks so much. They're relatively comfortable with the status quo. But central banks in China, India, Turkey, Russia, and dozens of other countries have been accumulating gold aggressively. Why does this matter? Because central banks don't buy gold on a whim. They're not speculating. They're not trying to make a quick profit. They're repositioning their reserves for a world where dollars might be worth less, where having hard assets matters more than holding paper promises from governments that might not be able to honor them. Gold has historically been the ultimate reserve asset, the thing that holds value when currencies fail. And when central banks start buying gold en masse, it's a signal that they're preparing for monetary instability. They're hedging against currency risk. They're diversifying away from fiat currencies, currencies that can be printed without limit, into something tangible and scarce. We're seeing similar patterns with other commodities. Countries are stockpiling critical materials, lithium, copper, rare earth elements. They're securing supply chains. They're building reserves of physical stuff rather than just financial assets. This is classic preparation for a period of currency instability. And the prices reflect this. Gold has been on a long-term uptrend despite rising interest rates, which historically would push gold prices down. Silver is moving. Commodities broadly are showing strength. This isn't just a bull market in commodities. It's a bull market in real assets versus financial assets, in things you can touch versus promises on paper. I've been watching this develop for years, and what strikes me is how consistent and persistent it is. This isn't a brief surge in gold buying that fades away. It's a steady, sustained reallocation by sophisticated actors who understand monetary systems. When central banks move, they move slowly and deliberately. And they're moving now. The BRICS currency and alternative systems. Let's talk about one of the most concrete manifestations of this shift: the BRICS nations' efforts to create alternatives to dollar-dominated financial infrastructure. Now, I want to be clear. There's a lot of hype and misinformation about this. People talk about a BRICS currency as if it's launching next month and will replace the dollar. That's not happening. But what is happening is more subtle and potentially more significant. BRICS countries are building the infrastructure for increased trade in their own currencies. They're creating development banks that offer alternatives to Western institutions like the IMF and World Bank. They're developing payment systems that don't rely on Western-controlled networks. The expansion of BRICS itself is significant. It started with 5 countries. Now it's adding members, countries that represent a significant portion of global population and GDP. These aren't fringe nations. These are countries that want more autonomy in financial matters, that want options beyond the Western-dominated system. Is this coordinated specifically to destroy the dollar? Probably not. Different BRICS countries have different interests and they don't always agree. But they all share one common interest: reducing their dependence on a system where the US makes the rules and can change them at will. Think of it like this. Imagine if all your financial transactions had to go through one company, and that company could decide at any time to freeze your accounts or deny you service based on whether they liked your behavior. You'd want an alternative, right? Even if you weren't planning to leave that company immediately, you'd want options. That's what these countries are building: options. And once those options exist and are proven to work, more countries will use them. Not necessarily because they hate the dollar, but because having alternatives gives them leverage, protects them from being cut off, allows them to pursue their own interests without worrying about US approval. What this means for your investments. All right, so we've established that something significant is happening in global currency dynamics. But what does that actually mean for you as an investor? Because understanding geopolitics is interesting, but it only matters if it helps you make better decisions with your money. First, currency devaluation is probably coming, at least in real terms. If the dollar gradually loses reserve status, if more trade bypasses dollars, if countries hold fewer dollar reserves, the value of dollars relative to real goods and services will likely decline. This is essentially inflation. Your dollars buy less over time. So what do? You position yourself in assets that hold value or appreciate when currencies weaken. That traditionally means real assets: real estate, commodities, precious metals, even quality stocks and companies with real earnings and ASEA. Second, diversification becomes even more important. In a world where currency relationships are shifting, you don't want to be entirely denominated in any single currency. This doesn't mean you need to open foreign bank accounts or buy property in 3 countries, but it might mean holding some assets that aren't purely dollar-based. Third, debt becomes riskier. In a stable currency environment, taking on debt at low interest rates can be smart leverage. But in a currency transition period where inflation might accelerate or financial instability might increase, being heavily indebted becomes more dangerous. The advantage shifts to those who have preserved purchasing power, rather than those who borrowed heavily. Fourth, quality matters more than ever. In stable times, you can get away with speculating on garbage assets because the rising tide lifts all boats. But in periods of monetary transition, the difference between strong assets and weak ones becomes stark. Companies with real earnings, real assets, and pricing power do better. Speculative bets on things with no fundamental value tend to get crushed. I think about my own portfolio and how I've adjusted it over the past couple years. I've increased my allocation to real assets. I own some gold. I own some commodity-focused investments. I've reduced cash holdings because cash is what's being devalued. I've focused on quality in my stock holdings rather than chasing growth at any price stories. And I've been very cautious about taking on new debt. This isn't about being paranoid or predicting apocalypse. It's about recognizing that the financial environment is shifting and positioning accordingly. Like a sailor who sees storm clouds forming. You don't abandon ship, but you do adjust your sails and secure your cargo. The timing question. Everyone wants answered. Here's the question everyone asks. When? When does this reset actually happen? When do currencies adjust? When should I make these changes to my portfolio? And the honest answer is, I don't know, and neither does anyone else. These macro transitions don't operate on predictable timelines. They can take years, even decades, to fully play out. And they don't happen smoothly. They happen in fits and starts, with periods of apparent calm followed by sudden shifts. What I can tell you is that the process is underway. The indicators are clear. The trends are established. Whether the major adjustment happens in 2026, 2027, 2030, or some other time frame, I can't say. But the direction is set. And here's the thing about timing that people don't want to hear. Trying to time it perfectly usually means you miss it entirely. The people who wait for the perfect moment to adjust their portfolios often wait until the obvious crisis hits, by which point the protective assets have already appreciated dramatically and they're buying at the top of the fear spike. The smart approach is to make gradual adjustments over time. You don't need to liquidate everything tomorrow, but you might shift your portfolio allocation over the next year or two. You might take some chips off the table from overvalued assets. You might build positions in things that protect against currency instability. Think of it like insurance. You don't buy homeowners insurance after your house catches fire. You buy it when everything's fine, when it seems like maybe you don't need it, because that's when it's available and affordable. By the time you obviously need it, it's too late. Separating signal from noise. I want to address something important. There's a lot of hype and misinformation around this topic. YouTube is full of videos with titles like "Dollar Collapse Next Week" and "Global Reset Imminent." Most of that is clickbait designed to exploit fear and drive views. The reality is more mundane. Currency transitions are messy, slow, complicated processes that unfold over years. There will be volatility. There will be periods where it seems like nothing is happening. There will be false starts and reversals. This isn't a movie where everything happens in 2 hours with a clear beginning, middle, and end. So, how do you separate signal from noise? A few guidelines. Be skeptical of anyone predicting exact dates or claiming to know precisely how things will unfold. Nobody knows. Pay attention to what sophisticated actors are doing, not what they're saying. Central bank actions, major country policy shifts, capital flows. These matter more than speeches and predictions. Focus on trends, not events. One headline about BRICS doesn't mean much. A sustained pattern of behavior over years means a lot. Remember that markets can remain irrational longer than you can remain solvent. Just because something seems inevitable doesn't mean it happens on your timeline. And perhaps most importantly, don't let this consume you. Yes, pay attention. Yes, adjust your strategy. But don't become one of those people who's constantly stressed about monetary collapse, who can't enjoy life because they're preparing for financial Armageddon. Moving forward. Look, the global currency system is shifting. That's not hyperbole, it's not fear-mongering, it's just observing what's happening. The dollar's dominance is eroding gradually. Alternative systems are being built. Central banks are repositioning for a different monetary environment. These are facts. But here's what's also true. The world isn't ending. Commerce will continue. People will still work, create, trade, build. Different currencies will rise and fall in importance, but human ingenuity and productivity don't disappear just because monetary arrangements change. What matters for you is being thoughtful about how you're positioned. Are your assets appropriate for an environment of potential currency instability? Do you have sufficient allocation to real assets? Are you avoiding the trap of holding everything in the form most likely to be devalued? These aren't radical moves. They're prudent adjustments for a changing environment. And if I'm wrong, if the dollar maintains its dominance and everything stays stable, you haven't hurt yourself. Real assets, quality investments, reduced debt, these are reasonable strategies in any environment. But if the trends continue, if we're genuinely in the early stages of a currency transition, then making these adjustments now while everything still seems relatively normal might be one of the most important financial decisions you make this decade. The reset isn't coming as a sudden apocalypse. It's already happening, slowly, gradually, in ways most people aren't paying attention to. And that gives you time to learn, time to adjust, time to position yourself intelligently for whatever comes next. So pay attention, stay informed, make gradual adjustments, but don't panic and don't become paralyzed by fear. Change creates opportunity for those who see it coming and prepare accordingly. And that's exactly what's happening.